So when it comes to exposure and portfolio management, and we cover this in a lot of detail in my MBA program, you've got to look at a couple things. Number one, you've got to look at sector exposure. And the way I'm going to answer this is a great way for all of us to manage our personal money. So if you have $100 to invest, I want you to make sure you don't have more than, say, 10% of your money in a particular sector, like the tech sector, or the retail sector, finance sector, et cetera, the banks. Okay, so that's one way to do it. You can look at sector exposure. Another way to do it is to look at asset class exposure. Have a nice mix of 25% stocks, 25% bonds, 25% commodities, and 25% other investments, maybe your own house, for example, or you can buy REITs, real estate investment trust, REITs. Another way to look at it is you also look at geographic exposure as well to diversify your risk. And so make sure you don't have too much exposure to one country. You want to be diversified globally. Also, make sure you don't have too much exposure to a specific currency as well. Now, in terms of portfolio management from a hedge fund perspective, if you're interested in longs and shorts, whatever you advertise to your investors, and make sure your lawyer takes care of this in the documentation, please, in the investment offer. Whatever you advertise, you have to stick to that. So if you tell your investors, I'm not going to ever have more than 10% long exposure, then what you have to do is analyze that as well, so that you have no more than $10 long the market relative to your shorts. You also want to look at beta adjusted risk. And so beta, we know, measures the volatility of a given stock. The S&P 500 beta is 1. If a stock has a beta of 2, it's twice as volatile as the S&P. So it goes up twice as much as the S&P and down a bunch more than the S&P if the market goes down. So you got to make sure you calculate not just your net exposure, but also your beta exposure. And if you want to take it to the next level, last thing I'll say about this is when I worked at a big hedge fund called Citadel, what we did was we had a lot of other variables, statistical variables, and we licensed it from a company called Barra, B-A-R-R-A. We had 86 independent variables that we would look at to manage our portfolio to make sure that we weren't too much beta long, net long, or momentum long either. Yeah.